Ever feel like your finances are playing an international game of hide and seek? Especially when you earn income abroad, that specter of being taxed twice, it can really loom large.
It definitely can.
But what if there was a powerful tool in your tax arsenal, designed to make that problem disappear, turning potential double taxation into, well, maybe even a strategic advantage?
Absolutely. Today, we're embarking on a deep dive into Form 1116. That's the foreign tax credit for individuals, estates, and trusts.
Right.
Our mission, to really unpack how this credit works, pinpoint exactly which foreign taxes are eligible, and guide you through the sometimes tricky intricacies of its calculation, all with a sharp focus on reducing your U.S. tax burden and, truly maximizing your financial efficiency.
We want to help you navigate these waters like a seasoned pro.
Exactly.
Our compass for this journey is the official 2024 instructions for Form 1116, straight from the IRS. Now, it can be dense, let's be honest, but we're here to extract those vital nuggets of knowledge for you, make sense of the rules, and highlight every possible avenue for, well, tax savings. So let's jump in.
Okay, so let's unpack this core concept first.
Sure.
The foreign tax credit, or FTC as you'll often hear it called.
Mm-hmm.
It's a specific provision that lets you, as a U.S. taxpayer, claim a credit for certain taxes, income, war profits, and excess profits, taxes that you've paid or accrued to foreign countries, or even U.S. territories.
Okay.
Think of it like a direct offset, dollar for dollar, right against your U.S. tax liability. It's really designed to be one of your most powerful tax-saving tools when you're dealing with international income.
That's a fantastic starting point. And the fundamental purpose here is, well, it's genuinely brilliant.
Huh.
It's all about preventing what people call double taxation.
Right, that's the key.
Imagine earning money in, I don't know, say France. You paid French taxes on it, and then the U.S. comes along and wants to tax that very same income all over again. That's just a financial headache nobody wants.
Exactly. Nightmare scenario.
So the foreign tax credit steps in to prevent that. It directly benefits you by reducing your U.S. tax liability. And it's not just a minor reduction sometimes. It can be a really substantial saving, making sure you're not penalized just for earning globally.
And that leads us right into a really crucial choice you face as a taxpayer.
Huh.
Do you claim a credit or take a deduction for your foreign income taxes?
Ah, okay. Credit versus deduction.
Right. While you can deduct foreign income taxes as an itemized deduction that's on Schedule A of Form 1040,
Mm-hmm.
the credit is almost always the more advantageous option for your wallet. Significantly so, usually.
Why is that? What's the big difference for us, the taxpayers? I mean, it sounds like a small difference in words, but important.
Oh, it's absolutely vital for maximizing your tax savings.
Right.
A credit is, you see, it directly reduces your tax liability dollar for dollar.
Okay.
So if you owe, say, $10,000 in U.S. taxes and you have a $2,000 foreign tax credit, boom, your U.S. tax bill immediately drops to $8,000. It's a direct subtraction.
Right off the top.
Exactly. A deduction, on the other hand, it only reduces your taxable income. So if you're in the 24% tax bracket, that same $2,000 deduction, it might only save you $480 in taxes because it just lowers the income amount before the tax rate is applied.
Wow.
So the credit provides a much more significant, much more direct benefit to your actual tax bill.
That is a huge difference. Okay, so generally, if you take the credit, you can't deduct those same foreign taxes. It's an either situation.
Correct.
But here's where it gets really interesting for planning. You mentioned flexibility.
Yes. The IRS actually allows you to switch your choice. This is pretty powerful.
How so?
Well, if you initially deducted foreign taxes, maybe you didn't realize the credit was better, you can elect to switch to claiming a credit within a special 10-year limitation period.
10 years? Seriously?
Yeah, under Section 6511D3. That's a huge window to go back and potentially save a lot more money.
That's incredible for tax planning.
It really is. And conversely, you can switch from a credit back to a deduction, though that's usually within the standard 3-year period. But this flexibility, it's a significant tool for optimizing your tax position, especially if your income or your foreign tax situation changes from year to year.
Right, so you can reevaluate, see which method gives you the most tax savings, even after you've filed. That's a key takeaway for optimizing.
Exactly. That flexibility can be a powerful lever. Now let's talk about who specifically needs to file this Form 1116.
Okay.
Primarily, it's individuals, estates, or trusts who have paid or accrued certain foreign taxes. But just as important is knowing who doesn't need it or maybe uses a different form just to make sure you're on the right track.
Good point. Any examples?
Sure. If you pay taxes to the U.S. Virgin Islands, for instance, you'd actually use Form 8689 instead of 1116.
Okay, different form for USVI. And what about people who aren't U.S. citizens or residents? Does this credit apply to them or usually not?
Generally, non-resident aliens cannot claim this credit. That's the standard rule.
But there are exceptions.
Yes, a couple of key ones. First, if you were a resident of Puerto Rico for your entire tax year, you might be eligible.
Okay.
Second, if you pay tax to a foreign country or a U.S. territory and foreign source income that is effectively connected with a U.S. trade or business, you might qualify.
Might. Sounds like a catch.
There is a crucial caveat for that second one. If you only pay tax to a foreign country on U.S. source income solely because you happen to be a citizen or resident of that foreign country, well, you can't use that specific tax to figure your U.S. credit.
Ah, okay. That distinction is vital. Getting that wrong could mess things up.
It really could. It's key for accurate filing.
Okay, so Form 1116, it can look pretty daunting. We've established that.
Mm-hmm.
But what if there was an easy button? You know, a shortcut that could save you time and complexity, especially if your foreign income isn't super complicated.
You read my mind. There is an often overlooked election that can truly simplify your tax filing. It's a real tax-saving shortcut for certain individuals.
An easy button. Tell me more.
Well, this election lets you claim the foreign tax credit without actually filing Form 1116 itself.
No Form 1116.
None. And what's even better, if you qualify and make this election, the foreign tax credit limitation. That whole complex calculation on lines 15 through 23 that requires all the income sourcing and apportionment,
Yeah, the really confusing part.
that just doesn't apply to you. It's a massive simplification. But, and this is a big but, it comes with strict conditions. You have to meet them all.
Okay, lay them on me. What are the key conditions to unlock this magical easy button?
All right. First, all your foreign source gross income must be what the IRS calls passive category income.
Passive income, so mostly interest and dividends.
Mostly interest and dividends, yeah. It also includes income subject to that special rule for high-taxed income we'll probably talk more about later, and certain export financing interest.
Yeah.
But think investments, primarily.
Wait, hang on. High-tax income isn't always passive. That sounds like a nuance people might easily miss.
It is. It's a crucial point. If passive income is deemed high-taxed, it actually gets reclassified, usually to general category income, for the limitation calculation.
Okay.
But for the easy button election, if it originates as passive income, it counts as passive for this specific rule. So it's about the initial nature of the income for this shortcut.
Got it. Okay, condition 1, passive income. What else?
Second, all this passive income and any foreign taxes paid on it must have been reported to you on a qualified pay statement.
Like a 1099.
Exactly. A Form 1099 DIV for dividends, 1099 INT for interest, or maybe a Schedule K1 or K3 from a partnership or S-Corp. Basically, something official the IRS can easily check.
Makes sense. And the third condition?
Third, your total creditable foreign taxes can't be more than $300, or $600 if you're married filing a joint return.
Ah, okay. That's a pretty low threshold.
It is. It's really designed for people with relatively simple, smaller amounts of international investment income.
So if you meet all 3 of those conditions, you're saying that whole foreign tax credit limitation calculation, part 3 of the form,
Poof.
gone. That's incredibly simplifying. A huge time saver. Sounds like a dream for casual international investors.
It absolutely is. Saves a lot of headache. But, important note, estates or trusts are not eligible for this particular easy button election.
Okay, individuals only. How do you actually make the election then if you don't file a form?
It's surprisingly simple. You just enter the smaller of your total creditable foreign tax or your regular U.S. tax directly onto the foreign tax credit line of your main tax return. For most people, that's Schedule 3, Form 1040, Part 1, Line 1.
That's it. No extra forms, just put the number on Schedule 3.
That's it. It streamlines things significantly if you fit those specific low-threshold requirements. A direct path to tax savings without the Form 1116 computation headache.
That is a fantastic simplification for many taxpayers. Okay, now let's get into the nitty-gritty. What foreign taxes actually count for this credit, and maybe even more critically, what doesn't?
Right, this is crucial.
Because this is where misconceptions pop up, right? And understanding these no-go areas is essential for your accurate calculation, for maximizing savings, and frankly, for avoiding issues with the IRS later.
Exactly. So at its core, eligible taxes are income taxes, war profits taxes, and excess profits taxes, or taxes paid in lieu of such taxes.
Okay.
This generally includes taxes paid to any foreign country or a U.S. territory. Think Puerto Rico, USVI, Guam, Northern Mariana Islands, American Samoa.
Right.
And yeah, there's some specialized situations, like U.S. citizens in certain treaty countries might get an additional credit, or there are specific rules for controlled foreign corporations, CFCs, where you might end up using Form 1118 alongside Form 1116. Those are deeper nuances, but important if they apply to you.
Got it. Now, the big one, the taxes that are not eligible. Where do people usually trip up here? This seems like a key area for tax savings by simply avoiding mistakes.
Absolutely. Understanding these exclusions is vital for compliance and avoiding disallowed credits. Let's hit a few common or surprising pitfalls. Number 1, taxes you don't legally owe. This is huge.
What does that mean exactly?
It includes amounts that are refundable by the foreign country, even if you don't actually apply for the refund.
Really? Even if you don't get it back?
Yes. Say a country withholds $25 in tax, but under a tax treaty between the U.S. and that country, you legally only owed $15. Only that $15 is creditable on your U.S. return.
Wow.
The insight here is critical. You have to exhaust all reasonable ways to reduce the foreign tax you legally owe, claiming a U.S. credit for taxes you could have gotten back from the foreign country. That's a common audit trigger, and frankly, you're just leaving money on the table internationally. Don't do that.
That's a huge heads up. Okay, what's another common one?
Number 2, withholding on dividends where you didn't hold the stock long enough.
Holding periods matter.
Big time. If you got dividends from a foreign company, but didn't hold the stock for at least 16 days within a specific 31-day window around the ex-dividend date, well, the foreign taxes withheld on those dividends are generally not creditable.
Okay, so short-term traders need to watch out.
Definitely. And the period is even longer for preferred stock dividends. It highlights how investment strategy can impact your tax credits.
Good to know. Any others jump out?
Number 3, taxes paid to certain specific foreign countries. The IRS keeps a list, you can find it in Publication 514, of countries designated as supporting terrorism, or those the U.S. lacks diplomatic relations with, or unrecognized governments.
Right.
Taxes paid directly to those specific countries are generally not creditable. Less common for most folks, but critical if you have income from one of those regions.
Okay. And a simple one.
Number 4, interest or penalties. Any interest or penalties you pay on foreign taxes, never creditable. Only the actual income, war profits, or excess profits tax itself qualifies. Seems obvious, but sometimes it gets bundled in.
Wow, that's an incredibly valuable set of insights. Knowing these exclusions is truly a critical tax-saving strategy in itself. It stops you from claiming an invalid credit, which avoids audits, penalties, amended returns. All that stuff costs time, stress, and money. It's about getting it right the first time.
Absolutely. Protect your savings, get it right. Now, related to this is foreign currency conversion.
Yes, the exchange rate.
Everything on Form 1116 has to be in U.S. dollars. So how do you convert?
Good question.
Generally, if you're claiming credit for taxes paid, cash basis, you use the exchange rate in effect on the day you actually paid the foreign taxes or the day the tax was withheld.
Okay, the rate on the payment date. What if you get a refund later?
If you get a refund of foreign taxes, you use the rate that was in effect when you paid the original taxes, not the rate when you received the refund. Keep things consistent.
Is there any wiggle room there, maybe for people using the accrual method?
Yes, there's a special election for accrued foreign taxes. If those taxes are in what's called a non-functional currency, basically, not the main currency of your business or economic environment, and you normally use an average exchange rate, you can elect to use the exchange rate on the date the taxes are paid instead.
Okay, pay date rate instead of average.
Right. Once you make this election, though, it applies to that year and all future years unless you get specific IRS consent to revoke it. It's a small detail, but can affect the numbers. Also, for QBU's qualified business units, those separate foreign trades or businesses pub, 514 has special, more complex conversion rules.
Good to know QBUs have their own rules. Now, what happens when things change after you file? Like you get a refund or there's an audit?
Yes. Foreign tax redeterminations, as the IRS calls them. This happens if your final foreign tax liability changes after you've already filed your U.S. return, claimed the credit.
Okay, so if I get a refund of taxes I already credited on Form 1116, what's the crucial implication for me in my U.S. filing? Do I just, pocket the refund and call it a day?
That's a definite no. The crucial implication is you must file an amended U.S. return, specifically Form 1040-X.
Must file, not optional.
Not optional. You have to reduce the taxes you originally credited by the amount refunded. It's a mandatory compliance step to correct your U.S. tax.
Okay. What other situations trigger this redetermination?
Other scenarios include things like changes in your foreign tax liability that affect complex income types like Sections 951, 951A, or 1293 income, or maybe changes impacting the high tax exception. Also, if you accrue taxes but translate them into dollars on the payment date, and the dollar value differs from the accrued value by more than a small amount, what they call de minimis, generally less than $10,000 or 2%, you need to redetermine.
So it's not just about refunds, it's about keeping your U.S. tax accurate based on the final foreign tax. I assume there are strict reporting requirements here for us listeners. How do we report this?
Absolutely. If a redetermination changes your U.S. tax liability for any prior year, you generally must file Form 1040-X and attach a revised Form 1116 for the affected tax year or years.
Okay, amended return, revised 1116.
And there's another piece. You also have to file Schedule C, Form 1116, with your current year tax return. Schedule C summarizes those prior year redeterminations. It gives the IRS a clear picture of all the changes across years.
Got it. Schedule C for the summer.
And be warned, penalties can apply if you fail to notify the IRS of these refunds or changes, unless, as they say, it's due to reasonable cause and not willful neglect. So proactive attention here is key to avoiding unnecessary costs. Protect your tax position.
Good warning. Okay, one final point on changes. What if foreign taxes are contested? You're fighting the foreign tax authority.
Right. Generally, you can't credit contested taxes until the dispute is fully resolved and the tax is definitively paid for U.S. tax purposes, which could take years.
Okay, so you wait, but you mentioned an election earlier.
Yes, there's an important election here that can be a valuable tax-saving strategy, the provisional credit election.
Provisional credit. Sounds like you get the credit before the fight is over. How does that work and who benefits? That could really help cash flow.
Indeed. It potentially accelerates your tax benefit. If you're on the cash basis, you can elect to claim a credit for a contested foreign tax liability in the tax year you actually pay that contested amount to the foreign country, even if the dispute isn't resolved.
So you pay the foreign tax under protest, and you can claim the U.S. credit right away.
If you make the election, yes. You file Form 1116 for that payment year, and you have to attach Form 7204, which is the specific form for this election.
Okay. What about accrual basis taxpayers?
Similar idea. If you're accrual basis, you can elect to claim the credit in the relation back year. That's the year the contested tax actually relates to once you make the payment. Again, you'd likely need to file amended Form 1116 for that relation back year and attach Form 7204.
And you have to keep track.
Yes. For both methods, you must file Schedule C, Form 1116, annually until the contest is finally resolved. And of course, if you end up getting a refund from that provisional credit later because you won the contest, that's treated as a foreign tax redetermination, triggering those amended returns we just talked about.
Okay, so it provides a way to get the benefit sooner, which is a great planning opportunity if you have significant contested foreign taxes. But you have to follow through on the reporting.
Exactly. It's a useful tool, but requires diligence.
Okay, so we've covered the basics, what counts, what doesn't, currency, redeterminations. Now, let's get into dissecting your income itself. This is where Form 1116 really starts to break things down with income categories.
Right, and the importance of these categories is huge because the fundamental rule is you must use a separate Form 1116 for each distinct category of foreign source income you have.
A separate form for each type. Why?
It's not just arbitrary. It ensures the proper calculation of the foreign tax credit limitation for each income type. This is absolutely crucial for accurately maximizing your overall credit and making sure you don't, say, over-credit taxes from one high-tax category against low-tax income in another.
Got it. Keeps things apples to apples for the limitation.
Yeah.
So what are the main categories we'll see on the form?
Okay, the big ones you'll likely encounter are, first, Section 951A category income. This is often called GILTI, Global Intangible Low-Taxed Income. It mainly applies to certain income inclusions from controlled foreign corporations, or CFCs.
Okay, GILTII. Complex area, I hear.
It is. Key things for Form 1116 are critically, no carryovers of unused foreign taxes are allowed for GILTI taxes. Zero carryover.
Good to know. Next.
Second, foreign branch category income. This is basically business profits of U.S. persons that are attributable to your foreign qualified business units, QBUs. Again, think separate trades or businesses you operate overseas. This category also specifically excludes passive category income.
Okay, so GILTI and branch are generally non-passive business type income. What about passive?
Third category, Passive category income. This is broad. It covers most interest and dividends. But crucially, pay attention to what it excludes.
Excludes? Like what?
It excludes things like export financing interest, active business rents and royalties, and most importantly for calculations, income the IRS considers high-taxed income.
Ah, there's that high-taxed income again. You said before it gets reclassified if it's passive but taxed heavily. How does that work? It seems counterintuitive and could really change someone's credit calculation.
It's a critical distinction, you're right, and a potential trap. Income is high-taxed if the foreign taxes you paid on it, after allocating expenses, exceed the highest U.S. tax rate that could apply to that same income.
Okay.
When passive income hits that threshold and is deemed high-taxed, it actually gets kicked out of the passive category and reclassified, usually into the general category income basket.
Wow. So it moves categories.
Yes, and this reclassification can significantly impact your foreign tax credit limitation calculations for both the passive category, which now has less income, and the general category, which now has more. It often ends up reducing the overall credit you can claim if you're not careful with tracking it. Also, financial services income earned by a financial services entity. Typically not passive either.
Okay, that's a huge point. High-taxed passive income isn't treated as passive for the limitation. What's next?
Fourth, the general category income. This is basically the catch-all. If your foreign income doesn't fit neatly into GILTI, branch, passive, or the other specific categories, it likely lands here.
What kind of income usually ends up here?
Think wages, salary, overseas allowances earned by employees working abroad, active trade or business income that's not branch income, gains from selling inventory or depreciable property used in a business. For many individuals working overseas, this is their main income category.
Okay, the big bucket. Are there others?
Yes, a few more specialized ones. There's Section 901J income. This is income from sanctioned countries we mentioned earlier, the ones the U.S. has issues with.
Right, where you generally can't credit taxes paid to that country.
Exactly. You still need a separate Form 1116 for income from each such country, but you usually only fill it out partially through line 17 because no credit is allowed for taxes paid to that sanctioned country. But remember, taxes paid to another country, like your country of residence, on income sourced from a sanctioned country can still be creditable.
Okay, tricky distinction there. What else?
Then there's certain income resourced by treaty. Sometimes a tax treaty between the U.S. and another country changes the source rules. It might treat income that would normally be U.S. source as foreign source.
The treaty overrides the usual rules.
Right. If you elect to apply that treaty provision, that income becomes foreign source for FTC purposes.
Yeah.
But here's the key. You must compute a separate Form 1116 for each specific treaty and the resourced amount involved.
Wow, separate form for each treaty resourcing.
Yeah.
Okay, last one.
Finally, lump sum distributions. This refers specifically to foreign source lump sum distributions from pension plans. They have special calculation formulas and worksheets, usually detailed in IRS Publication 575.
Okay, that is a lot of categories. It really hammers home why you can't just lump all your foreign income together. It's like sorting laundry whites, colors, delicates. Each needs its own Form 1116 for the best result, the maximum clean credit.
Exactly. Good analogy. Now, within Part 1 of Form 1116 on Line I, there's a default rule to report things on a country-by-country basis.
Right. If you have income and taxes from, say, both the UK and Germany, you use a separate column in Part 1 and a separate line in Part 2 for each country.
That's the default. But thankfully, there are exceptions where you can aggregate, which simplifies things.
Okay, aggregation exceptions. Like what?
Well, for Section 863B, income that's certain income from services or inventory that's partly U.S., partly foreign source, you don't need per-country reporting for the foreign part. You just total all that foreign source income in the applicable category in one column and write 863B on Line I.
Nice. Save some columns. What else?
Similarly, for RIC pass-through amounts, that's income passed through to you from mutual funds or regulated investment companies. You can total all that income in a single column and just enter RIC on Line I.
Okay, RICs get aggregated.
Also, remember Section 951A inclusions are GILTI. Since those are computed on separate Forms 8992 anyway, you generally don't need to report those inclusions country by country on Form 1116. Just enter the total GILTI inclusion in a single column in Part 1 and write 951A on Line I.
Okay, GILTI gets aggregated too. Makes sense. What about that high taxed income, the HTKO that got kicked out of passive? Does that get special treatment for country reporting?
Yes, it does. If passive income gets reclassified as high taxed, you use a separate column in Part I specifically for that high taxed amount. You enter HTKO on line I. There are specific instructions for making positive and negative entries across the relevant forms 1116, the passive one it left and the general one it likely joined, to make sure the reclassification is tracked correctly for the limitation calculation. It's detailed, but crucial for accuracy.
Got it. HTKO gets its own column. Okay, what about partners and S-Corp shareholders? They get that Schedule K3 now. How did that feed into Form 1116?
Right. Schedule K3 provides the information you need. For categorization, you'll generally still use a separate Form 1116 for each income category and a separate column or line for each country or aggregated amount, just like anyone else.
So K3 gives the raw data, and we sort it onto the right Form 1116 in the right category and country column. How does the income sourcing work from K3? Does it tell me if it's U.S. or foreign?
Mostly. For income sourcing, look at Schedule K3, Part 2, Section 1. Amounts reported in columns B through E there. That income has already been sourced by the partnership or S-Corp, broken down by country and category.
Oh, convenient.
Yeah, you can generally just take those numbers and plug them directly into Part 1 of your applicable Forms 1116.
Nice. What about column F? It says sourcing determination required.
Right. Column F usually reports income from the sale of eligible personal property. For that income, you, the partner or shareholder, have to determine if it's U.S. or foreign source.
How to do that?
Generally, if you're a U.S. resident, that income is U.S. source. If you're a non-resident, it's usually foreign source. But there are caveats, like needing a foreign tax of at least 10% paid on the gain or having a tax home outside the U.S. The key is only the foreign source portion goes onto your Form 1116.
Okay, so column F needs extra work. What about deductions from the K3?
Similar idea. Schedule K3 Part 2 Section 2 columns B through E generally show deductions already allocated and apportioned by the entity to foreign source income by category. You'd include these on line 2, directly related deductions, of your applicable Form 1116.
Okay, K3 helps with direct deductions. Now, interest expense. I know that can get tricky for individuals. What about from a K3? This feels like a significant area for potential tax optimization, right? Getting the allocation right.
It absolutely is. Interest expense is reported on Schedule K3 Part 2, Section 2, usual lines 39-43. The key is that you generally have to allocate and apportion this interest expense yourself, usually based on either your gross income or your assets.
So the K3 gives me the total interest, but I decide how much goes against foreign versus U.S. income.
Largely, yes. And this is a huge point for maximizing your tax savings. How you allocate that interest directly impacts your foreign tax credit limitation. If you can properly allocate more interest expense to your U.S. sources, that leaves your foreign source income higher, which can increase the amount of foreign tax credit you're allowed. It's a subtle but effective way to optimize.
Is there a simpler way for some partners?
Yes, for less than 10% limited partners, there's often a simplification. They can generally allocate interest expense based just on their share of the partnership's gross foreign versus U.S. source income, and it's usually allocated exclusively to passive category income, much simpler than the asset method.
Good tip for limited partners. Okay, finally, the actual foreign taxes paid from K3 Part 3.
Right, Section 4. These are generally already allocated and apportioned by the partnership or S-Corp. You just take those amounts and include them in Part 2, foreign taxes paid or accrued, of your applicable Forms 1116, matching them to the right country and category.
And redeterminations. If the partnership's foreign tax changes later,
those changes would be reported on your K3 too, and you'd then report them on your Schedule C, Form 1116, for the year you receive the updated K3. Keeps the tracking consistent.
Okay, now let's start into the actual numbers, the nuts and bolts of calculating income and taxes in Parts 1 and 2 of Form 1116. This is where we start to really see how the form works to deliver those tax savings line by line. Let's start with Part 1, taxable income or loss from sources outside the United States.
Right, this is where you calculate your foreign source income for the purpose of the credit limitation.
Lines 1A and 1B, foreign gross income, what goes here?
You include all income in the specific category you checked at the top of Part 1, that's taxable by the U.S., and sourced from the country you put on line I.
Okay. Even if that foreign country didn't actually tax it.
Yes, if it's U.S. taxable and foreign source for U.S. rules, it goes here. You also need to identify the type of income on the dotted line next to 1A, like dividends, wages, business income.
And I assume you don't include income you've already excluded somewhere else, like on Form 2555 for foreign earned income.
Correct. Definitely do not include any earned income that you properly excluded using the foreign earned income exclusion on Form 2555. That income isn't subject to U.S. tax, so it doesn't factor into the credit calculation here.
Got it. Excluded income stays out. Is there anything special for employees on line 1B?
Yes, there's a specific compliance check. If the income on line 1A is employee compensation and your total employee comp from all sources is $250,000 or more, and you use an alternative basis for sourcing that compensation, not the usual time or geographical basis, then you must check the box on line 1B and attach a detailed statement comparing your allocation method to the standard methods.
Okay, that's a very specific rule. Good flag for hiring employees using unusual sourcing methods. Compliance detail, but essential for accuracy.
Absolutely. Now, lines 2 through 5. This is where the math gets really interesting for maximizing your tax savings, because this is where you allocate deductions and losses against that foreign gross income.
Why is this so key for savings?
Because the core principle is you must reduce your foreign gross income by expenses directly related to it, and also by a fair share, a ratable share, of other general deductions that aren't clearly tied to either foreign or U.S. income.
Okay.
This reduction directly impacts the crucial number your net foreign source taxable income, which is the basis for your foreign tax credit limitation. The less foreign income you have after these deductions, the lower your limitation might be, potentially reducing the amount of foreign tax credit you can actually use. So careful, accurate allocation here is key to optimizing your credit.
So minimizing the deductions allocated against foreign income maximizes the potential credit.
Got it. Now, what if I don't itemize deductions on my main U.S. return? I just take the standard deduction. How does that work here?
Good question. If you don't itemize, you simply enter your standard deduction amount on line 3A. And you don't include any deductions that would have gone on Schedule A elsewhere on Form 1116.
Okay, standard deduction goes on 3A if not itemizing. Right. And remember, don't include deductions related to exempt or excluded income, like that Form 2555 income. You can't deduct expenses against income that isn't taxed anyway.
Makes sense. Okay, line 2. Directly related deductions. What goes here specifically?
These are expenses that tie directly to the foreign gross income you reported on line 1A.
Examples.
If you reported foreign business income on 1A, you'd include business expenses like supplies, advertising, local licenses incurred for that foreign business. You also include state and local income taxes if they are directly related to and applicable to that specific foreign source income. You should attach a statement listing these out.
Okay. State taxes if related to the foreign income. What about interest expense? Does that go here?
No. Crucial caution. Do not include interest expense on line 2. Interest has its own special allocation rules we'll get to on line 4. Keep interest separate.
Got it. No interest on line 2. And what about that overall limit on state and local tax deductions? The $10,000 SALT cap.
Great point. The deduction for state and local taxes on your Schedule A is generally limited to $10,000 per household, $5,000 if married, filing separately. So you cannot deduct more than this $10,000 limit in total across all lines on Form 1116 where state and local taxes might appear, primarily line 2 and line 3A combined. Don't double dip beyond the cap.
Okay, respect the SALT cap even on Form 1116. So line 2 is for direct ties. What about those other more general deductions that aren't specifically U.S. or foreign? Where do they go?
That's where lines 3A and 3B come in for other indirectly related deductions. These are deductions that don't directly relate specifically to your foreign income, but also aren't definitely related only to your U.S. income.
Okay, the general stuff. What goes on 3A?
Line 3A includes certain itemized deductions from Schedule A, like medical expenses, general sales taxes, if you choose those instead of income, real estate taxes for your personal home, state and local personal property taxes. And again, if you didn't itemize, your standard deduction goes here instead.
Okay. And 3B?
Line 3B is for any other deductions that aren't definitely related to any specific type of income. Think maybe certain adjustments to income from Schedule 1, Form 1040, Part 2. For both 3A and 3B, you should really attach a statement listing out what these deductions are for clarity. Helps you, helps the IRS.
Good practice. Okay, now we need to figure out how much of these line 3A, 3B deductions actually gets allocated against the foreign income. How does that work?
Right. That involves lines 3, 3E, and 3F, first lines 3 and 3E, gross income for apportionment. We need to define gross income here carefully. It means your total gross receipts, less cost of goods sold, total capital and ordinary gains, calculated before any losses are netted, and all other income before any deductions.
Okay, gross income, top line number. What's third?
Line 3 is your gross foreign source income, specifically from the category of this particular Form 1116. Important. You should include any foreign earned income excluded on Form 2555 here, even though it's excluded for tax. It's still part of your gross foreign income for this specific apportionment calculation.
Okay, include excluded income on third for the ratio. What's 3E?
Line 3E is your gross income from all sources, U.S. and foreign, across all categories. This is a crucial number. It's a constant. You'll enter the exact same figure on line 3E for every column of all Forms 1116 you file for the year.
So line 3E is like your total global gross income, and it stays the same across all your 1116s. That's a key anchor point.
Precisely. And line 3E also includes any foreign earned income you excluded on Form 2555.
Got it. So third is foreign gross for this category. 3 is total global gross.
Then what? Then line 3S is where you calculate the ratio. You divide line third, foreign gross in this category, by line 3E.
Yeah.
Total global gross. You need to round this ratio to at least 4 decimal places, but it can't be more than 1.
Okay. Third divided by 3E gives the ratio.
Exactly. And this ratio on 3F is what you'll multiply by those general deductions on lines 3A and 3B to figure out the portion that gets subtracted from your foreign income. It ensures a fair share of your overall general expenses, reduces your foreign source income.
Makes sense. Now, what about interest expense? You said it gets special treatment on line 4.
Yes, lines 4A and 4B deal with interest expense allocation. This is another area where strategic, proper allocation can significantly impact your foreign tax credit.
Okay, line 4A, home mortgage interest. How does that work?
There's a helpful simplification here. If your gross foreign source income, again, including any excluded Form 2555 income, doesn't exceed $5,000, you have a valuable option.
$5,000 threshold. What's the option?
You can choose to allocate all of your deductible home mortgage interest expense to U.S. source income.
Allocate it all to U.S. source. Why is that helpful?
Because it means none of your home mortgage interest reduces your foreign source income. This leaves your foreign source income higher, which can potentially increase your foreign tax credit limitation. It's often a beneficial choice if you qualify.
Nice simplification and potential tax saver. What if your foreign income is over $5,000?
Then you generally have to apportion your deductible home mortgage interest using a gross income method. There's a specific worksheet for this in Publication 514. More complex.
Yep. Okay. Now, what about line 4B? Other interest expense, like investment interest or business interest. Lots of listeners with foreign investments might have this.
Right. Line 4B includes things like investment interest, trade, or business interest. That wasn't directly related on line 2. Passive activity interest. And guess what?
Let me guess. Same $5,000 threshold.
You got it. If your gross foreign source income, including excluded income, doesn't exceed $5,000, you can again choose to allocate all of this other interest expense to U.S. source income. Same potential benefit of maximizing your foreign source income for the limitation.
Another great potential tax saver if you're under that 5K foreign income level. What if you're over $5,000 for this other interest?
If you're over the threshold, then an asset method is generally used for apportionment. This gets quite detailed and is covered extensively in Pub 514. But let's use an example from the instructions to show the concept and the potential impact.
Okay, example time.
Suppose you have $2,000 in investment interest expense that needs allocating. And let's say your total assets are worth $100,000. Of that, you have stock-generating U.S. source income with an adjusted basis of $40,000. That's 40% of your assets. And you have stock-generating foreign source income with an adjusted basis of $60,000. 60% of your assets.
Okay, 40% U.S. assets, 60% foreign assets.
Right. Using the asset method, you'd apportion 40% of that $2,000 interest expense, which is $800, to your U.S. source income. The other 60% of the $2,000, which is $1,200, gets apportioned to your foreign source income. You would then enter that $1,200 on line 4B of the relevant Form 1116.
That's a powerful illustration. So understanding your asset allocation between U.S. and foreign sources becomes critical for this interest expense calculation. And again, allocating more interest to U.S. sources means less reduction of your foreign source income. This can be a subtle but highly impactful tax-saving benefit by maximizing your foreign tax credit limitation. It's all about protecting that foreign income number.
Exactly right. Proper allocation is key. And finally, for Part 1, line 5, foreign capital losses. Just a quick note here. Special adjustments are usually required for foreign source capital gains and losses. You often need to use Worksheet A or B from the Form 1116 instructions, or look at Pub 514. You can't just plug in the net loss directly. Specific rules ensure they're handled correctly for the FTC calculation.
Okay, capital gains and losses need special handling. Got it. That wraps up Part 1, calculating the foreign taxable income. Now, Part 2.
Right, Part 2. Foreign taxes paid or accrued. This section is where you actually list the foreign taxes you paid or are claiming as accrued for the credit.
And remember, only the eligible ones we talked about earlier: income, war profits, excess profits taxes, or taxes in lieu of those. Not the non-creditable ones like taxes you didn't legally owe or interest and penalties.
Precisely. Keep that list of non-creditable taxes handy. Now, here in Part 2, there's another big choice that can significantly impact your tax planning: the cash versus accrual election for claiming the credit.
Ah, yes, you mentioned this briefly. How does this election work again, and why is it important for planning?
Okay, if you normally report your income and expenses on a cash basis, meaning when you actually receive income or pay expenses, you have the option here. You can elect to take the foreign tax credit for taxes when they accrue, even if you haven't paid them yet.
So claim the credit earlier when the liability arises, not when you pay.
Exactly. You make this election simply by checking the accrued box in Part 2 on a timely filed original return. But here's the important implication. This is generally a one-time binding election for all future years.
Once you choose accrual, you stick with it.
Generally, yes, unless you get IRS consent to change back. So once you make the accrual election, you must credit foreign taxes in the year they accrue on all future returns. This can be a beneficial tax planning strategy if you want to claim the credit earlier, maybe matching the timing of the tax benefit closer to when the income was earned. You could potentially accelerate your savings.
Interesting. So a timing choice with long-term consequences. Okay, what if a single foreign tax payment relates to income in more than one category? Like maybe a tax covers both general and passive income?
Good question. If a foreign tax paid or accrued relates to more than one income category, you have to apportion that tax among the relevant categories.
How do you apportion the tax itself?
It's usually based on the ratio of net foreign taxable income in each specific category, after deductions, compared to the total net foreign taxable income across all categories that the tax relates to.
Okay, based on the proportion of income in each category. Now, any special reporting things in the columns of Part 2?
Yes, a couple of specific callouts. If you have taxes that were previously suspended under Section 909, related to certain asset transfers, but are now allowed, you enter 909 taxes in column L. And here's a helpful simplification for many investors. If your foreign tax on passive income, like dividends or interest, is reported to you in U.S. dollars directly on a Form 1099 DIV, 1099 INT, or a similar qualified pay statement, you don't need to convert that amount back to foreign currency and then back to dollars.
Oh, nice. Use the dollar amount from the 1099.
Yes. You can just enter the U.S. dollar amount shown on the 1099 directly into Part 2 and write 1099 taxes in column Valley. Saves you a conversion step and potential exchange rate hassle.
That's a great practical tip. And always remember to attach statements if needed, like for taxes from a foreign audit or reflecting a refund, since those are redetermination.
Absolutely. Documentation is key.
Okay, now we get to the real climax, the crunching of the numbers. Figuring the actual credit and applying the all-important limitations in Part 3 of Form 1116. This is where it all comes together, and where understanding the nuances can directly translate into maximizing your tax savings. Let's start with line 10. Carryovers and carrybacks of unused foreign taxes. This sounds like a major tax-saving lever.
Oh, it absolutely is. This is a crucial feature and one of the most powerful tax-saving mechanisms baked into the foreign tax credit system.
How does it work?
Simple concept, powerful impact. If your creditable foreign taxes paid or accrued in 1 year exceed the calculated credit limitation for that year, we'll get a limitation calculation soon, that excess tax isn't necessarily lost forever.
Okay, so you don't just lose the benefit.
Not necessarily. The IRS allows you to carry that excess tax back 1 year and then carry it forward for up to 10 years.
Wow, back 1, forward 10.
Right. This means you can potentially use those excess foreign taxes in different tax years where you do have enough U.S. tax liability and enough foreign source income relative to your worldwide income to absorb them.
That's a significant tax-saving mechanism. It lets you utilize otherwise lost credits in other years. It really smooths out your tax liability over time, especially if your income or your foreign tax situation fluctuates year to year. So if I can't use all my foreign tax credit this year, I might be able to use the leftover part to save big next year or the year after, or even use it against last year's tax.
Exactly. That's the power of carryovers. You apply the excess to the earliest year first. So if you had excess credits in, say, 2024, you'd first look to carry them back to your 2023 return. You might even get a refund for 2023 if the carryback applies.
Nice.
If any excess credits still remain after the carryback, You then carry them forward year by year, 2025, 2026, and so on, for up to 10 years, so until 2034 in this example.
Okay. Are there restrictions?
Yes, important ones. First, you can't carry a credit back to a year where you chose to deduct foreign taxes instead of claiming the credit. Remember that credit versus deduction choice. It impacts carrybacks.
Right. Stick with the credit to use carrybacks.
Also, remember the easy button, the election not to file Form 1116. If you use that simplification in a prior year, you cannot carry over taxes to or from that specific year. It's a trade-off for the simplification.
Ah, okay. Using the easy button blocks carryovers for that year.
Correct. And one more big one. Remember that GILTI category, Section 951A income. No carryovers back or forward are allowed for foreign taxes related to GILTI income. Those taxes are use it or lose it in the current year.
Wow, no carryovers for GILTI. That's harsh.
It is. So keeping diligent records of your foreign tax credit carryovers by category is absolutely paramount for long-term tax optimization. Schedule B, Form 1116, helps with this tracking.
Okay, carryovers are key. Now, line 12. Reductions to foreign taxes. You mean the taxes we listed in Part 2 might get reduced before we even calculate the credit?
Yes, exactly. Your actual foreign taxes paid or accrued from Part 2, Line 8, might need to be reduced on this line before they flow into the final credit calculation. This prevents you from claiming an inappropriate or excessive credit amount.
What kind of reductions are we talking about?
Several key ones. A big one is taxes on income excluded on Form 25555.
Ah, the foreign earned income exclusion again.
Right. If you excluded foreign earned income or housing amounts using Form 25555, you must reduce your foreign taxes paid or accrued by the amount of tax that's allocable to that excluded income.
How do you figure that out? Sounds complicated.
The calculation involves a specific fraction, which can be complex. Basically, the numerator is your excluded income minus deductible expenses allocable to it, and the denominator is your total foreign earned income minus its allocable deductible expenses. You multiply your foreign taxes by this fraction to find the non-creditable portion. The core idea is simple, though. You can't get a U.S. credit for foreign taxes paid on income that isn't even subject to U.S. tax in the first place because you excluded it.
Makes sense conceptually.
Yeah.
No double benefit. What else reduces the taxes?
There are others, like taxes related to certain income from Puerto Rico or American Samoa that's exempt from U.S. tax, or taxes on foreign oil and gas or mineral income under specific circumstances. But another one to really highlight is the reduction for failure to file Form 5471.
Form 5471. What's that again?
That's the information return U.S. persons often need to file if they have interest in certain foreign corporations. It's a critical compliance form.
Okay, and failing to file it impacts your foreign tax credit.
Significantly. If you're required to file Form 5471 and you failed to do so by its due date, including extensions, your creditable foreign taxes are reduced by a hefty 10% penalty. And that penalty can increase for continued failure.
Wow, a 10% hit to your credits just for missing a form.
Yes, this is a major compliance trap. Avoiding this penalty by filing Form 5471 on time is a direct tax-saving strategy. Don't let a paperwork oversight cost you valuable credits.
Huge heads up for anyone with foreign corporate interests. Any of the reductions?
One more complex one involves taxes related to a foreign tax credit splitting event. This is an anti-abuse rule. Basically, if the foreign tax is paid by one person, but the related income is actually recognized by a different person, a covered person, you generally can't take the credit for that tax until the tax year, when the covered person actually takes the related income into account. It prevents certain timing games.
Okay, so these reductions are really about making sure the credit claimed aligns properly with U.S. taxable income and compliance rules. It's like a built-in integrity check, but also a crucial guide for us on proper compliance. Understanding these is key to accurate filing.
Precisely. Getting line 12 right avoids overstating your creditable taxes. Now, we move to the absolute core of the limitation calculation, lines 15 through 17, which ultimately determine your foreign source taxable income after all adjustments. Line 15 generally pulls your taxable income from Part Y, line 7. But then line 16 is where critical adjustments happen, recharacterizations, recaptures that directly impact the amount of foreign source income available for the credit.
Okay, line 16 adjustments. This sounds really important for the final credit amount. What are these adjustments?
They are absolutely vital for maximizing or sometimes minimizing your credit, depending on the situation. Let's break down the crucial ones. First, allocation of foreign losses. If you have a net loss in one foreign income category on line 15, say a loss in your general category, but you have income in one or more other foreign categories, like passive or branch, that foreign loss first reduces your income in the other foreign categories proportionally.
So foreign losses offset other foreign income first, before hitting U.S. income.
Exactly. Only then, if there's any foreign loss left over after offsetting all other foreign income, would that remaining loss reduce your U.S. source income? Let's use the example from the instructions. Say you have a $2,000 loss in the general category, but you have $4,000 of income in the passive category and $1,000 of income in a treaty resource category. Total $5,000 of other foreign income. That $2,000 general loss would be allocated 80%, 4K will have, okay, or $1,600 to reduce the passive income, and 20%, 1K or 5K, or $400 to reduce the treaty income. Your U.S. income wouldn't be touched by this foreign loss.
Okay, that preserves the U.S. tax base. Foreign losses stay foreign as much as possible.
Right. Now, the flip side, allocation of U.S. losses. What if you have an overall net loss from your U.S. sources?
Does the U.S. loss reduce foreign income?
Yes. If you have a net U.S. source loss, that loss is allocated proportionally and reduces your foreign income in each separate foreign category that has income. This effectively recharacterizes some of your foreign source income as U.S. source for the limitation calculation.
And that's generally bad for the foreign tax credit, right? Because it lowers the foreign income base for the limitation.
Correct. A U.S. loss can directly reduce your ability to claim foreign tax credits by shrinking the foreign income component of the limitation formula.
Okay, loss allocations are critical. What's next on line 16? Recaptures.
Yes, recaptures. This is where past years come back to affect the current year. First, recapture of prior year overall foreign loss accounts.
OFL accounts, what are those?
Think of an overall foreign loss OFL account like this. If, in a prior year, you had a net loss in a particular foreign income category that was large enough to offset some of your U.S. source income, you created an OFL account for that category. It's like a debt of foreign losses you used against U.S. income.
Okay, I used a foreign loss to reduce U.S. tax in the past. Now what?
Now, in the current year, if you have foreign source taxable income in the same category as that prior loss, the IRS requires you to recapture that prior benefit. A portion of your current year's foreign income in that category is recharacterized as U.S. source income.
So it reduces my foreign income this year.
Yes. This recapture reduces your creditable foreign income and therefore reduces your potential foreign tax credit for the current year. The amount recaptured is generally the lesser of the total balance in your OFL account for that category, or 50% of your current year's foreign source taxable income in that category. Though, note, it can be up to 100% recapture if you dispose of property that was predominantly used outside the U.S. in that loss category's business.
So the IRS claws back the prior benefit. That can definitely lower your current year credit.
It's designed to do just that. Make sure the prior benefit was temporary. Now, related, but different. Recapture of separate limitation loss, SLL accounts.
SLL. Another type of loss account.
Yes. This happens when, in a prior year, a loss from one foreign category reduced income in another foreign category. Remember how foreign losses offset other foreign income first? If that happened, you create an SLL account.
Okay, foreign loss in Category A reduced foreign income in Category B last year. Now what?
Now, in the current year, if you have income in the category that had the loss originally, Category A, a portion of that income is recharacterized as income in the category that absorbed the loss, Category B.
So income moves between foreign categories this year.
Exactly. Let's use the example again. Say in 2024, your general category loss reduced your passive and treaty income. You'd create SLO accounts showing general O's, passive, and treaty. Then in 2025, if you have general category income, some of that 2025 general income gets recharacterized as passive income, and some as treaty income, effectively repaying those categories for absorbing the loss in 2024.
Does this affect the total foreign tax credit?
It can, because the limitation is calculated separately for each category. Shifting income between categories changes the limitation for each. Importantly, recharacterizing the income doesn't recharacterize the tax associated with it. The tax stays in its original category.
Okay, that's complex. SLL moves income between foreign categories. One more recapture.
Yes, and this one is often beneficial for your foreign tax credit, recapture of overall domestic loss, ODL accounts.
Domestic loss. So U.S. losses again.
Right. Think of an overall domestic loss, ODL account, as the flip side of an OFL. It's created if, in a prior year, you had a net U.S. source loss that offset some of your foreign source income. Remember how U.S. losses can reduce foreign income? If that happened, you have an ODL account. It's like a credit of U.S. loss that hit your foreign income.
Okay, U.S. loss reduced my foreign income and FTC limit last year. Now what?
Now, in the current year, if you have U.S. source taxable income, A portion of that U.S. income is recharacterized as foreign source income in the categories that were previously reduced by the domestic laws.
Wait, U.S. income becomes foreign income? That sounds good for the credit.
It generally is. This ODL recapture increases your foreign source income and consequently can increase your foreign tax credit limitation, allowing you to use more of your foreign taxes.
That's a fantastic potential benefit. How much gets recharacterized?
The amount recharacterized is generally the lesser of the total ODL account balance, or 50% of your current year's U.S. source taxable income. However, the Tax Cuts and Jobs Act, TCJA, included a provision allowing taxpayers to elect to recapture up to 100% of their pre-2018 ODL balances through the 2027 tax year. That could be a significant planning opportunity to boost your FTC limit if you have old ODL accounts.
Wow. Okay, these line 16 adjustments, loss allocations, OFL recapture, bad for FTC, SLO recapture, shifts income, ODL recapture, good for FTC, are incredibly nuanced but absolutely essential for calculating your foreign source taxable income correctly on line 17. Getting these right is key to maximizing savings because a misstep could leave money on the table or cause compliance issues. It's like fine-tuning an engine.
Couldn't have said it better. Precision matters here. Now, after all that, line 17 shows your foreign source taxable income after these adjustments. Then we get to line 18, worldwide taxable income. But wait, there's potentially another adjustment here.
More adjustments. Okay, what impacts worldwide taxable income on line 18? This sounds like where qualified dividends and capital gains might get complicated again.
You nailed it. Your worldwide taxable income figure, which starts with your total taxable income before exemptions from your main return, may need to be adjusted, especially if you have qualified dividends or net capital gains, including foreign source ones, that are taxed at those preferential lower rates, 0%, 15%, 20%.
Why the adjustment?
Because the FTC limitation tries to compare apples to apples. It limits your credit based on the U.S. tax on your foreign ordinary income relative to your worldwide ordinary income, roughly speaking. Since qualified dividends and capital gains get lower tax rates, they need to be adjusted out of the main calculation or adjusted in a way that reflects their lower tax burden to get an accurate limitation percentage. You'll often need to use this specific worksheet for line 18 found in the Form 1116 instructions to figure this amount correctly.
Okay, another worksheet for qualified dividends and capital gains. But you hinted earlier there might be a simplification here too. An easy button for line 18 expense.
Yes, thankfully, there is a potential off-ramp. You can elect not to make these potentially complex adjustments to your qualified dividends and capital gains on line 18 if two conditions are met. First, the amount on line 5 of the main qualified dividends and capital gain tax worksheet from your Form 1040 instructions doesn't exceed certain income thresholds. For 2024, those were around $383,900 if married filing jointly, $191,950 for most others. And second, your total foreign source net capital gain plus your foreign source qualified dividends is less than $20,000.
Okay, so if your income isn't super high A&D, your foreign capital gains dividends are under $20.
Then you can elect to skip the line 18 adjustment worksheet. You just use your regular worldwide taxable income. This is a fantastic simplification for many taxpayers with moderate investment income, saving significant time and potential confusion. Another example of the IRS providing an out for less complex situations.
Definitely worth checking if you qualify for that election. Okay, line 18, done. What's line 20?
Line 20. Regular U.S. income tax liability. This is the U.S. tax amount against which the foreign tax credit is actually allowed. It's the ceiling in a way.
Where do we find this number?
For individuals, you'll generally find this on line 16 of your Form 1040, 1040-SR, or 1040-NR. You might also need to add certain additional taxes from Schedule 2. For estates and trusts, there are specific lines on Forms 1041 or 990 days T. Crucially, you don't include certain taxes listed in Section 26(b)(2), things like the net investment income tax, NIT, because the foreign tax credit generally doesn't offset those specific taxes.
Okay, so it's your main income tax liability before credits, excluding certain specific taxes like NIT. Got it. Now, line 22, increase in limitation, Section 960C. This sounds specialized. Who does this apply to? Potentially beneficial.
Yes, specialized and potentially very beneficial, mainly for U.S. shareholders of controlled foreign corporations, CFCs. Remember GILTI and Subpart F income. Sometimes U.S. shareholders have to include income from a CFC even if they don't receive a distribution.
Right, previously taxed income.
Exactly, previously taxed earnings and profits. PCHEP. Under Section 960C, If you establish what's called an excess limitation account in prior years related to taxes deemed paid on that PTEP, and then in the current year you receive an actual distribution of that PTEP, which is excluded from your gross income, you might be eligible for an increase in your foreign tax credit limitation for the current year.
So getting the actual cash out triggers a boost to your FTC limit.
It can, yes. It's a complex rule, but it's designed to help you utilize foreign tax credits associated with that PTEP that might otherwise be trapped due to limitation issues in the year the income was originally included. It prevents a form of double non-taxation credit mismatch.
Okay, complex but powerful for CFC shareholders getting PTEP distributions. And here's the really exciting part I saw in the outline. If this line 22 increase is so large that it actually exceeds your U.S. income tax liability for the year,
Yes.
the excess is deemed an overpayment, and it can be a refundable credit claimed on Schedule 3, Form 1040, Part 2, line 13 cents.
That is correct. In that specific scenario, the excess limitation increase under 960C can actually result in a direct tax refund. It's not just reducing your tax bill to zero. It could be money back in your pocket. A very welcome outcome indeed for those navigating the complexities of CFC taxation and PTP.
Wow, a direct tax refund opportunity hidden in the FTC rules. Amazing. Okay, we've gone through all the adjustments and calculations. We finally arrive at line 24. The maximum foreign tax credit, the grand finale for this category.
Exactly. This is the bottom line for each separate Form 1116 you're completing. The amount on line 24 is the smaller of two key numbers. Either the allocated U.S. tax attributable to your adjusted foreign source taxable income in this category, that's the limitation amount you calculated on line 21, or the actual creditable foreign tax you paid or accrued related to this category from line 14, which is line 8 adjusted by line 12 reductions.
So your credit is kept. It's the lesser of the U.S. tax on that foreign income or the actual foreign tax paid on it. You only get credit up to the amount of U.S. tax you would have owed on that income anyway.
Precisely. The U.S. won't give you a credit for foreign taxes that exceed the U.S. tax rate on that same slice of income. That's the fundamental principle of the limitation.
And if your actual foreign taxes paid, line 14, are greater than the calculated limitation, line 21, that means line 21 is the smaller number, and that's your credit for the year. But what about the difference?
That difference represents your excess foreign taxes for this category in this year. And that's where those incredibly valuable carryback and carry-forward provisions we discussed from line 10 come right back into play.
So the unused portion, the excess taxes, can be carried back 1 year or forward 10 years to potentially reduce tax in those other years. This is where diligent record-keeping of your foreign taxes and limitations really pays off, allowing you to maximize your overall tax savings over the long haul. It truly is a marathon, not a sprint, with international tax planning.
Absolutely. Couldn't agree more. Okay, we've conquered the complexities of parts 1, 2, and 3 for a single category. But what if you had to complete more than one Form 1116 because you had income in multiple categories? That brings us to the final section, part 4, summary of credits from separate parts 3.
Right. So if you, the listener, had, say, both passive category income, Form 1116 tag 1, and general category income, Form 1116 tag 2, you'd have calculated a separate credit on line 24 of each form. How do you bring them all together to get the total credit onto your main tax return, like Form 1040?
Good question. You don't just add them up separately on the main return. Instead, you use Part 4 on only one of your Forms 1116 to summarize everything.
Which one do you use for the summary?
You pick the Form 1116 that has the largest amount entered on its own, line 24. That becomes your summary, Form 1116.
Okay, find the form with the biggest credit and use its Part 4.
Right. You enter that form's line 24 amount on line 24 of Part 4. Then, you summarize the credits you figured on all your other Forms 1116 onto lines 25 through 31 of this summary Forms Part 4. You then total them all up on line 32, and that total credit from line 32 is what flows to your main tax return, like Schedule 3 of Form 1040.
Got it. So one form acts as the master summary sheet for all the category credits, and you attach all the individual Forms 1116 to your return.
Yes, definitely attach all of them, just a small exception. The instructions say you generally shouldn't use a Form 1116 for lump sum distributions, Category G, or sanctioned country income, Category E, as your summary form, unless those happen to be the only two categories you're filing for. Minor detail, but good to know.
Okay. Now, beyond the main Form 1116 itself, you mentioned some essential companion schedules earlier. Can you quickly recap those?
Sure. Two key ones to be aware of for properly managing your foreign tax credit situation over time. Schedule B, Form 1116. This schedule is specifically for foreign tax carryovers. You use it to reconcile your prior year foreign tax carryover amounts with your current year carryovers, tracking additions, new excess credits generated this year, and subtractions, carryovers used this year or expiring. It's vital for keeping track of those valuable carryover assets.
Okay. Schedule B for carryover tracking. What was the other one?
Schedule C, Form 1116. This schedule is critical for reporting those foreign tax redeterminations we talked about. If you had a change in your foreign tax liability for a prior tax year that occurred in the current year, like getting a refund or paying more after an audit, you report the details on Schedule C filed with your current year return. It's the IRS's main way of tracking these adjustments across years.
So, Schedule B for carryovers, Schedule C for redeterminations. These schedules are absolutely vital for your ongoing compliance and making sure you properly track your foreign taxes across years. They're not just optional add-ons, they seem necessary to correctly manage your foreign tax credit position, prevent issues, and make sure you can fully leverage those carryovers or report refunds correctly. Safeguards your savings and keeps you compliant.
Precisely. Don't overlook them if they apply to your situation. Now, for listeners who want to dive even deeper or have very specific situations, the IRS provides some excellent IRS resources for more help.
Where should people look first?
I highly recommend Publication 514, Foreign Tax Credit for Individuals. It's the comprehensive guide that goes into much more detail on many of the calculations, definitions, and nuances we touched upon today. It's your ultimate reference.
Pub 514. Got it. Any others?
Yes, depending on your situation. Pub 54, Tax Guide for U.S. Citizens and Resident Aliens Abroad, is great for broader expatriate tax issues. Pub 519, U.S. Tax Guide for Aliens, is key for non-residents dealing with U.S. tax. And Pub 570, Tax Guide for Individuals with Income from U.S. Territories, covers specifics for places like Puerto Rico, Guam, etc.
Excellent resources. And if someone needs to actually contact the IRS while overseas?
The number provided for international callers is 267-941-1000. Just be aware it's not a toll-free number, or you can send written inquiries to Internal Revenue Service, International Accounts, Philadelphia, PA 19255-0725.
Okay, good contact info to have. Wow, that was truly a deep dive into Form 1116. We went from the basics of what the credit is, through what taxes qualify, and importantly, what don't. Navigated those complex income categories, dug into the allocation of deductions and the limitation adjustments and recaptures. It's crystal clear the foreign tax credit is an incredibly powerful but definitely intricate tool for anyone earning income internationally.
Absolutely. It can definitely seem overwhelming with all its moving parts, the categories, the adjustments, the carryovers, the schedules. But, as we've discussed, grasping these mechanics is so crucial if you have any international income.
Yeah.
It's fundamentally about ensuring you're not paying more tax than you legally owe, avoiding that double taxation, and really maximizing your tax efficiencies globally. When used correctly, it turns that potential pain point of double taxation into significant tangible savings. Every line, every election we talked about has the potential to impact your final tax bill and unlock hidden value.
So as you, our listeners, reflect on your own global income streams, maybe consider this. How might really unraveling these specific rules, like understanding the nuances between income categories, strategically using that easy button election for simpler passive income if you qualify, or maximizing the powerful benefit of carryovers and maybe even ODL recapture, how might that not only optimize your tax return this year, but also empower your future international financial decisions? How can you transform tax compliance from feeling like a burden into a genuine strategic advantage?